Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
During the first half of this fiscal, foreign direct investment equity inflows fell by 14%. The total FDI, which includes equity inflows, also saw a contraction of 9%. So what led to this fall and what could be its impact on the Indian economy? Bhaswar Kumar breaks it down for you.
According to a recent forecast by Morgan Stanley, India is likely to become the world's third largest economy by 2027. But the projection comes with a rider: favorable global as well as domestic conditions. And one of the important factors for growth is inflow of FDI. The more, the merrier. So it was heartening when the centre in September said that the country was on track to attract $100 billion in FDI in the current financial year, up from the highest ever foreign inflows of $84 billion in the previous year. But the unfavorable global situation and the ongoing economic slowdown are emerging as hurdles in the country's pursuit of that goal. India saw its FDI equity inflows fall nearly a quarter to $10 billion in the September quarter from a year earlier. Data released by the Department for Promotion of Industry and Internal Trade showed that total FDI inflows, which include fresh FDI equity inflows, reinvested earnings, and other capital, fell 16% to below $17 billion in the second quarter from a year ago. In the first half of the current financial year, FDI equity inflows fell 14% to below $27 billion, and total inflows fell almost 9% to $39 billion from a year earlier.
I don't think the number of 100 billion will be attained this year. And the way in which I look at it is when the government talks of 100 billion, it's a kind of a goal which we had. Given the fact that we have clocked over $80 billion in the last couple of years, there was reason for one to be a bit more sanguine about FDI increasing towards the 100 billion level. But today, the way in which things have turned out, and given the fact that the recession is going to be deeper in 2023 than what we have seen in 2022, I think that there would be a further slowdown in terms of FDI inflows.
Why has such a situation emerged, even as India is being seen as a bright spot in the global economy? Are we seeing the results of increased uncertainty and a reduced appetite for risk among investors? After all, even Vietnam, another bright spot and often viewed as India's competitor in vying for FDI, saw its FDI inflows dip in the first 10 months of calendar year 2022.
The principal reason for this shortfall in equity flow in the FDI inflows has to be the uncertainty in the global economic environment. Because I think the entire global scenario is now plagued with this uncertainty due to the pandemic, due to the Ukraine-Russia war. I would hazard the guess that this has got more to do with the external conditions rather than anything to do with the Indian economy or the domestic conditions within India.
The Make in India initiative completed 8 years in September. There has also been renewed emphasis on the ease of doing business in recent years. Last but not least, the government continues to increase the scope of its flagship production-linked incentive schemes, which aim to attract more FDI into India's manufacturing sector.
The dip in the FDI is, in my view, almost entirely due to the external factors, and also the fact that these PLI schemes are yet in the making, and therefore, only a few have been, as it were, tendered out and notified, and the others are in the pipeline. And I think, as these schemes, develop, mature, we will see more FDI flowing in. So I would not see this dip as a comment on the success of the PLI schemes.
While these schemes may boost FDI inflows into India in the medium term, what will the coming months look like?
Yeah, I would tend to think that FDI under equity as well as the total inflows, which also includes the reinvestments, will come under pressure, primarily on account of the fact that the total quantum of investable resources has come down ever since quantitative tightening has been started by both the Federal Reserve as well as ECB, because these are the two main areas from where funds come to emerging markets. So definitely going ahead as things get tighter, and that is what the central banks are working at, it will automatically lead to a compression in the overall amount of funds, both in terms of FDI as well as FPI, which can be invested in other markets. And here, since we're talking of FDI, there would continue to be pressure in terms of gross inflows into the economy. Even in terms of reinvested earnings, may be a tendency for some of the companies to actually repatriate the profits or the net income which they make out here. And that's why I think that even the reinvested earnings could tend to decline over a period of time, which of course has repercussions as far as our balance of payments are concerned, given the fact that when we are running a current account deficit, we were relying a lot on capital flows, especially FDI, which is of a permanent variety, to help to balance the external account.
The current situation may pose a serious challenge for the government, especially since a previous business standard report had assessed that even $100 billion of FDI may not be sufficient to finance the burgeoning current account deficit.
There has been an uptick in FDI in the Indian automobile sector over the years. It is expected to become the world's third largest by 2026. Back home, people are thronging the showrooms to drive new cars home. The sales of passenger vehicles shot up 29% last month. Meanwhile, a parallel industry of second-hand cars is also thriving, and it is becoming increasingly organized. The market for second-hand cars is expected to double in the next 5 years. Is the used cars then the new deal for Indian auto buyers? Deepargo Sanyal drives home the logic behind buying a pre-owned car.
According to a report by OLX Autos, jointly produced with CRISIL, the second-hand car market is expected to double from 4.1 million units to over 8.2 million units by FY27. In this process, the value of this market is likely to touch 4.3 to 4.5 trillion rupees by FY27. At the same time, the new car market in the country is expected to touch 6.6 to 6.8 trillion rupees in the same period. This gap was more pronounced at the end of FY22. It was 1.8 trillion rupees for second-hand cars and 3.3 trillion rupees for new ones, the study observed. With the used car market growing at a CAGR of 16%, the gap is expected to further widen by 17 times in the next 5 years. In terms of segments within the second-hand car market, the share of utility vehicles or UVs has gone up over the past 5 years, from 17% in FY17 to 22% in FY22, and it is expected to rise further to 32% in FY27. The growth in utility vehicles has come at the expense of sedans and vans. However, OLX Group Chief Executive Officer Amit Kumar told Business Standard that small cars are likely to remain a favorite of the value-conscious first-time buyers. Small cars still account for a good 58% in the overall second-hand car market in FY22 and will only see a marginal drop of around 200 basis points by FY27. Puneet Gupta, director at S&P Global Mobility, lists out the major factors why the used vehicles are doing so well.
So one is obviously the industry has really become quite organized, and I think one of the big reasons for it becoming organized was, entry of startup players, And the second big reason is average price of the Indian car industry. In last 3 years, the prices have gone up by roughly 30%. right? Adding to this, was the availability. There were a lot of supply shortages. There were supply chain issues. There were issues related to imported parts, typically coming from neighboring markets like China. So all these part together, really led to non-availability of new cars. So I think so used car really come as a great alternative, because you really get a value proposition, because actually a lot of consumers have really not run their vehicles in last 3 years because of pandemic.
The process of buying second-hand cars has also become smoother and more systemized thanks to the healthy competition between players like Cars24, Spinny, Carwale, etc. Gajendra Jangid, co-founder and CMO of Cars24, explains.
So, gone are the days when customer really have to, feel really fearful if they really want to buy or sell used cars. We are providing complete transparency to the customer about the car, where the car has been done in the past, what the kilometer, what is the service history looks like, and over and above, the warranty. Like when every car comes with the warranty, customer also feels that, okay, I don't need to worry about it when there's skin in the game from the brand I'm buying car from. So when the market gets organized, that consumer feel more and more confident to, transact, in that ecosystem. And of course, new car get depreciate much faster. You end up losing 20 to 30% in first year, and then, more as you move forward. So nobody wants to lose that much amount of money when they have the same amount of trust in the used car.
But while the second-hand car market enters a boom period, there are several challenges on the horizon that major players should be wary of, according to Gupta.
So I think first thing is that once you see the new car, discount on new cars going up, so you will see, that customers going back to new cars, right? So another big challenge is, right, we have a lot of fleet which is of internal combustion engines, right? So that is only available as used cars, right? So whereas, if today you see a lot of consumers, typically in urban or aspirational buyers, typically in young category, right, they may really look forward for electric cars, right? So primarily, I think there can be a little of mismatch, between what consumers may be looking for, and what these players will be offering. And then third is these companies, have to really need to reach the Bharat, the rural part of India, because obviously, a 10-year-old diesel car may not have any buyer in Delhi or in Mumbai or Chandigarh, right? But they may have buyers in those small villages or small tier 3 cities, because there the regulations may allow, such kind of vehicle.
Jangid also points to the issue of financing, the need for a more thorough record of cars usage data, and a uniform tax regulation for buying and selling cars across states.
Used car financing is less than 15%, 15%, as compared to new car with the financing is very easily, like almost more than 75% of the car get financed. So you can see the difference. Like used car financing ecosystem is very underpenetrated as compared to new car. When you can't value the goods very accurately, you kind of hesitate to finance that good, right? So able to determine the right market price, right, that will further boost the overall financing coverage. The second thing which I feel is very important, there is no one place where I can go and look for the service history of cars, or there is no a single place where I can go and look for the, let's say, insurance record, or any repair or damage work has been done on the car. Another part which I think in a way government of India has already started solving is about one nation, one tax. If government of India can really come up with a system where I don't really need to re-register and repay the entire lifetime tax in the new state where I'm buying car from, then anyone can buy a car from anywhere, and it's just become, the entire buying and selling become much more frictionless.
The booming demand for personal cars in the post-pandemic period may have given a boost to the second-hand car market. But for this boom to be sustained, the market needs more financing options for buyers and favorable regulatory changes.
Easing chip shortages have also helped auto sales touch the 1 million mark in Q2. However, as demand entered a slow lane amid weak exports in October and the end of the festive season, the rally in auto shares lost steam. Will this trend continue? Let's find out in our next report.
Robust festive demand amid easing semiconductor supplies and commodity prices led to year-on-year jump of 48% in automobile sales in October this year. According to the Federation of Automobile Dealers Association, as many as 2.09 million vehicles were sold last month compared to 1.42 million units in October 2021. This was also 8% higher than pre-COVID level. Earlier in September, the domestic passenger vehicle industry posted its best ever monthly sales with industry volumes at 356,000 units. This was a year-on-year increase of 91%, which propelled the second quarter sales to cross the 1 million mark.
Festive season has been decent across two-wheelers and four-wheelers. Two-wheelers and four-wheelers both have recorded double-digit growth in the festive season as per Vahan data. Inventory levels have come to manageable levels. Within the portfolio, we have seen the entry level for both two-wheelers and four-wheelers underperforming the premium side of the demand. Also, scooters has outperformed motorcycles and urban has outperformed rural. In that context, we will see going forward demand for new launches being strong. However, there will be some moderation post the festive season. Overall, we don't see any risk to our growth numbers for two-wheeler, four-wheeler and CVs, which stand at around 15% for two-wheelers, 20% for PVs and 30% for CVs.
Financially, most automobile majors reported better than expected September quarter results due to better product mix, higher volumes, and per unit realization.
I would say the quarter two numbers were quite positive, and especially knowing the fact that the full benefit of lower commodity cost have yet not reflected in the quarter two numbers. As you know, that typically the auto OEMs do have the benefits of the commodity cost always comes with a lag effect. And when you look at the commodity cost index between quarter one and quarter two, the quarter two, as we speak, commodity cost index is down by 70 to 80%, and this benefit should reflect in quarter three numbers. So we do see there's a scope for margin improvement, as we move towards quarter three and quarter four. We do expect that as the increase in MSP and maybe certain recovery on the rural economy side, probably hopefully second half of this fiscal year should see continuous sustained improvement on the rural economy side.
That said, momentum in the auto pack is slowing down. After rallying up to 83% between April and October this year, shares of auto firms fell in November. This was driven by profit booking coupled with concerns of weakening of exports. So far this month, shares of Eicher Motors, M&M, TVS Motor Company, Maruti Suzuki and Ashok Leyland have dropped between 5% and 12%. While Bajaj Auto and Hero Moto fell up to 1.7%, Tata Motors is the only stock that rose 3% this month. In comparison, Nifty Auto Index dipped 4.5%, while the Nifty 50 Index added 1.4%. So, will this weakness in the auto pack continue?
There is not a runaway rally so far. The market is rewarding only the outliers and the winners at this point of time. But the recovery prospects are very clear for the sector when looked at from the point of view of commercial vehicles as well as passenger vehicles. And yes, of course, we think two-wheelers will also play the catch-up. So at this point of time, there is no room for disappointment. Even if we see any kind of slowdown, we may at the best see a consolidation and not a fall from these levels.
Clearly, analysts see auto stocks doing well from a 1 to 2 years perspective as the sector is recovering from its cyclical lows. The slowdown in exports and rising interest rates may cloud the near-term outlook. As regards today, stock-specific action and global cues will guide market action.
Speaking at the Bengaluru Tech Summit, Minister of State for Electronics and IT, Rajiv Chandrasekhar said that the next generation of devices and products like India Stack is being built and designed right here. But have you ever wondered what India Stack is? In our next report, we offer an insight into this platform and how it will help India achieve its ambitious digital transformation goal.
India's ambitious project Open Network for Digital Commerce, or ONDC, which seeks to rival US giant Amazon and Walmart-backed Flipkart, went live in Bengaluru recently, and it uses India Stack as a platform. India Stack is a moniker for formidable digital infrastructure which includes identity, payments, and data management. Governments, startups, and developers used this infra to accelerate India's shift to not only a digital economy but also an inclusive one. The India Stack infrastructure has revolutionized the way both small and big businesses transact with their customers. According to the International Monetary Fund, it has widened access to financial services in an economy where retail transactions are heavily cash-based. India Stack was built on layers of technologies and frameworks such as Aadhaar, UPI payments, digital locker, and others. The foundation of India Stack is Aadhaar, which helped the government create a biometric database, and its linkage to bank accounts accelerated the financial inclusion and improved service delivery. Over 1 billion Indians have an Aadhaar card with a unique identification number. For years, government welfare delivery was not efficient. Aadhaar not just improved the last mile delivery, but also became the basis for many flagship schemes such as Jan Dhan Yojana, Kisan Samman Nidhi Yojana, etc. Then came the Unified Payment Interface, or UPI, that allowed millions of users to transfer payments instantly. Fintech companies with digital wallets made transactions instant and simpler. Currently, UPI monthly transaction volumes are over 5 billion. The third layer in the India Stack project is the introduction of DigiLocker, which allows verification of digital documents without physical presence. People can upload their key documents such as Aadhaar, PAN card, driving license, etc. in the DigiLocker and use them for verification as and when required. For instance, digital lenders could quickly verify the documents and sanction loans based on the credit history. The fourth layer, which is not yet fully operational, is to enable secure movement of data with the consent of users. This layer allows data to move freely and securely to democratize the market for data.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to a report, India is expected to propose the creation of a robust digital architecture with the G20 presidency. That's all for today. For more news and analysis, please log into our website business-standard.com, and we'll see you on Monday morning. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.